Recording. There we go. How's everybody doing today? Let me stop sharing my screen. Let me see who I'm talking to here. Let a few more people in as well. Hope you guys are all doing well. Happy Tuesday. Drop in the chat where you guys are tuned in from. Want to see where you guys are. And today is going to be a fun one. You know, we're on lesson number 4 using the trend trap strategy, right? We covered a variety of different things, which we're going to go over today as well. Each of the steps for those of you guys that weren't on the previous sessions. But in today's lesson, you know, I want to talk about the shield, right? And before we do that, let's see where you guys are tuning in from. Kamloops, Old Alberta, Toronto, Kamloops, WI. Where's WI? I'm not very familiar with that. And then Thorndale, Ontario. I'd love to see it. Welcome, welcome. But today we want to talk about the shield, right? Nebraska in the house, Wisconsin. That's what it is. That's my bad. But today we want to talk about the shield and what is the shield? What do you guys think is the shield when it comes to trading, right? If you think shield, you think protection, and when you think of those two words and you pair it with trading, what do you think that would refer to, right? Drop in the chat. What do you guys think the shield or the protection would refer to when we talk about trading? Right? So it's one of the most important things with trading, right? You could have all the right setups, right? You could have the perfect trade idea. You could have the perfect analysis, right? Top-down analysis with whichever strategy that is that you use, right? But if you don't have one thing, which is the shield, right? You could, instead of keeping the money in your account, you could lose everything because the shield is proper risk management. Exactly. Josh got it in the chat there. And proper risk management, right, is really about protecting the capital that's in your account, right? What that is every trade that you're taking, you're competing with somebody else who's trying to make money in these markets as well, right? There's people buying and selling nonstop every single day, right? And if the market is going a specific direction, if you're in profit, that means somebody else is losing, right? And if you're in a losing trade, that means somebody else is winning, right? But how do we use proper risk management or the shield when it comes to trading to protect the capital in our account, right? It's one of those things where when you really learn and understand the importance behind risk management, right, and why it's so necessary, this is where I had major breakthroughs in my trading, is keeping the capital in my account, right? Because you could have, with proper risk management, we're going to go into it and what that looks like. But with proper risk management, right, you could win very few amount of trades and still be profitable, right? We're going to talk about that here and just show this in perspective, right? So if we take, right, we talk about a 1-to-3 risk to reward ratio, right? So let's draw this out here. 1-to-3 RR, right? What does that mean? You have a 1-to-3 risk to reward ratio. That means for every trade that you take, right, you're either risking 1 to 2% of your capital that you have, right? Or you're risking a dollar amount, right? I don't like to go more than 1 to 2% of the account size that I have, right? But if I'm risking 1 to 2%, and that means for the risk to reward ratio, for it to be a 1-to-3, that means for every trade that I take, I would be making, for every 1% I'm risking, I would be making 3% to 6%, right? For a 1-to-2 or 1 to 2% is what I'm risking, right? And 3 to 6% is what I'm gaining from that. right? And if you're doing a dollar amount, that would look like, let's say you have $100 account, right? You would want to risk $10 per trade, maybe, right? It's a little bit more than 1 to 2%, but on a $100 account, $10 is usually what you would want to risk per trade, right? That way, the numbers are very even and it looks good, and you can also grow your account a little bit easier doing that, right? You're still using the same risk to reward, but now you're just using a dollar amount, right? Let's say you're using $10 is what you're risking. That means for every trade, your 1 to 3 risk to reward, right? You would be making $30, right? And why is this so important with a 1 to 3 risk to reward, right? Because if you take, right, 10 trades, right, doesn't matter if it's in a week, in a day, hopefully it's not in a day, but if it's in a week or in a month, whatever that looks like when you're taking 10 different trades, right? And you use a proper 1 to 3 risk to reward ratio, right? Let's say you took a trade on Monday, then on Tuesday you took two, Wednesday you took one, or whatever it looks like. You took 10 trades, right? Let's go. We won one trade, then we lost a couple trades in a row. Let's say we lost three, then we won one, then we lost three more, won one, and we lost the last trade that we took, right? So we had in total 10 trades with 3 winning trades and 7 losing trades, right? If you take this now, right, we're going to expand this a little bit here, and you risked, right, 1 to 2%, or in this case, we're going to use the dollar amount in this case, right? We're going to use $10. You risk $10 for every trade to make 30, right? Your 1 to 3 risk to reward. On your first trade, right, we are in profit $30, right? We're going to do plus $30. So now, what's the next trades that we took, right? We took 3 losing trades in a row, right? So those 3 losing trades, each time we took a losing trade was minus $10, right? And then if you add those 3 losing trades in a row, you lost $30 for those 3 losing trades, right? You didn't risk more of your capital. You stuck with the 1 to 3 risk to reward. You won $30 on your first trade, and then you lost $30 on your 3 trades combined, right? Each one of those trades is $10. So $30 combined. Then you won another trade for another $30, right? Plus $30. And then you're losing 3 trades again in a row, right? So that's another minus $30. But then you won a trade, right? Plus 30 again, and you only lost one, right? You took 10 trades, you lost 7 of those trades, but won 3, right? What would that be? So we'd be minus $10 for this last trade, and overall we would still be plus $20, right? So if you compound this over time, right, for every 10 trades that you take, consistently you're sticking to your plan, you're sticking to proper risk management, no matter what, if you only win 3 trades, right, and lose 7 of your 10 trades, you can still come out profitable, right? That means for every 3 losses, 1 win will wipe out all of those negative losses, right? 1 win will put you back to break even, right? Or if you have 1 win, you have 3 losses to be back to break even where you started, right? The reason why we use a 1 to 3 risk to reward is because that's the higher probability of you becoming profitable in the longer period of time, right? You don't want to be the guy or the girl that comes into trading, gets one massive trade for 200 pips, or you just made $2,000 trade by over leveraging your account, and then you start taking other trades and you just keep losing and losing and losing because you don't have a proper risk management plan, right? You don't have a plan to scale your account. If you do this over and over and over again using a 1 to 3 risk to reward, right? You will always be, if you stick to your plan, right? You're not going to win every single trade. If you stick to your plan, you get the entries that you want, right? That react in our zone that we talked about in the previous sessions, right? You wait for the reaction, you wait for the breakout with the trend trap, right? A 3-to-1 risk to reward for every 10 trades you take, and you lose 7 and win 3, you are still in profit overall. Does that make sense? Let me go over here in the chat. There's a few people in the waiting room as well. Grady, I'm gonna make you host or co-host. If you want to let people in that you see in the waiting room, that would be sweet if you're able to do that. But hopefully that is making sense, right? For those of you guys that were not yet in the call, in the waiting room, we just going over proper risk management, right? Which shows if with using a 1-to-3 risk to reward ratio, you can lose 7 trades out of 10 and still be profitable with only 3 winning trades if you stick to your plan. Right? This is why lesson number 4 is the most important one when it comes to trading, is because this is where you are protecting the capital that's in your account. Right? We want to be able to protect what's ours and not always be risking everything to, make those big trades. Right? Get the $100 trade, the $1,000 trade, the $10,000 trade, right? We want to be consistently stacking wins, right? And building a consistent risk management and building our portfolio over time, right? That's the importance of risk management, right? And how do you do this once it comes to once it comes to the trades that we take using the trend trap strategy, right? We're gonna go over this again. What we covered, right, is step number 1, right? If we mark this out here, step 1 was what? Just to recap on trend trap, what we've been going over the last few weeks, right? Who can put in the chat what is step number 1? Who can remember, for those of you guys that were on the sessions? The daily range. Exactly. You want to find your daily range, right? And your trend. This is all one step, right? Finding the daily range. And step 1 is called the trend, right? We want to find the trend. Which direction is the market moving into, right? Step number 2 is the zone, right? We want to know which area the market is going to come to react off of, right? What's the most high probable areas in the market where the market is most likely to react, right? In our given trend that we're looking for, whether that's an uptrend or a downtrend, we want to be looking for different zones, right, for the market to react off of. And then step number 3, which we covered last week, is the breakout, right? And then step number 4, which we're covering today, is the shield, right? So we're going to go over these again just to recap what we did, but just to quickly finish off on this thought on risk management, right, is you don't want to chase the markets, right? When you're not using a proper 1-to-3 risk to reward ratio, right, and you're just getting in whenever, or you're not sticking to your trading plan, right? You start losing a few trades and you're not, mentally in the right headspace, right? You don't have the right mindset when it comes to trading, is because you're not using a proper risk management plan. Right? If you're constantly glued to your phone or glued to your trading app, MetaTrader, or whatever trading app you use, right? It's because you don't have a proper risk management plan. right? If you need to see every time the market is in profit, every time it's getting closer to your stop loss or whatever, so you close out in less drawdown, right? You don't have a proper risk management plan, right? That's what happens when you don't follow your proper risk management plan, is you start to chase the market, right? You start to see things, or your brain starts to convince you you're seeing things happening in the market, so you go back into the trade rather than sitting there waiting on your hands and waiting for the market to react off of your zones, right? Going through the strategy and waiting for a reaction, right? You start chasing the markets, right? You move your stop loss lower and you start taking bigger losses. That's another thing that can happen, right? I've seen that many times, with me when I started trading. Was I would convince myself so much that I saw something happening in the market that I would move my stop loss lower if the market got close to my stop loss. And then I would just end up losing more money because the market was clearly doing something else, right? It was going against me. I didn't have the proper setup, but I thought I did. I convinced myself I did. So I moved my stop loss lower to stay in that trade because I knew it was going to react. And then it didn't, and it just wiped me out anyways, but now in way more of a loss than before, right? And if you don't have proper risk management, one day can erase a full week of good trades, right? And then your mindset from there collapses, right? This is why 90% of people who are traders or call themselves traders, right, lose in the financial markets, is because they don't have a proper plan, right, when it comes to their risk management plan, when it comes to protecting the capital that's in their account, right? It doesn't matter if you have $100 in your account or if you have $10,000 in your account, right? What matters is, what are you doing to protect the capital, right? And add to it using a proper risk management plan, right? So just to recap, for those of you guys that haven't been on the sessions or maybe missed the last few, I want to go over with you guys exactly the trend trap strategy again, right? From step one, the trend. So we're going to do this using Bitcoin and just look over this here. All right, let me just remove this stuff here. There we go. Right, so with Bitcoin right now, we can see that we have the first step is to look for our daily range, right? What is our closest daily high and our closest daily low to current price, right? So current price, if you on TradingView, is right where this dotted line is going across, right? You can see the price over here on the right side. And the daily range is the closest bullish candle followed by a bearish candle to price, right? So right here we can see we have a bullish candle followed by our bearish candle. This is our daily high, right? So this is where we're going to put our daily high. And our daily low is a bearish candle followed by a bullish candle closest to price. So we're going to put that right here. Right now, we know exactly the zone that we're going to want to trade in. Right? We know what the area looks like, what that daily range is. And from here, we go to the 4-hour chart. Right? The 4-hour chart. And from the 4-hour chart, now we want to identify which trend the market is in. Right? We want to identify highs and lows which the market is creating, right? The most recent 3 highs and lows on the 4-hour time frame to figure out which trend we are currently in, if we're in an uptrend or a downtrend, right? So how we do this is I like to look for the closest highs and lows to current price, right? So we can see right here we have a low that's close to price. But is this the lowest low that we have in this chart right here? Drop in the chat if this right here is the lowest low. Right, you want to identify your lower lows, your higher highs, right? Jeremy says no. Exactly. This over here, we move to the left side and see if there's any price that moved lower than this low that we have here, and this would be our lowest low. Right? We're focusing on what the market is doing now, right? We don't want to focus on back here, and this low was clearly lower than this low. It was, but we're focusing on our daily range, right? What's near or in our daily range, right? Where we can see highs and lows being created, right? So here is our lower low. Now let's go to the next one. And from this lower low, which move, right, created this lower low? Was it this move from here to here? Or was it this move from here to here that created that lower low? Right? Was it number one from right here, this first move, or was it number two, this second move? Right? If you said number one, you're correct. If you said number two, you're also correct. Both of them created that low. But what I like to look for is actually if the market, right, moved side to side and created a level or an important zone, right, where the market kind of moved side to side for a little bit, right? If the market just went from down this straight down candle and then just moved one candle over and then straight down, right? This is a little bit more advanced than what we went into, but I'm going to share this because it makes sense and I think this is very valuable for you guys, right? If the candle moves side to side, right, or even back up, it does a retracement, right, for 3 to 4 candles before continuing down, this is an important zone to consider, right? This is our next higher, or in this case, lower high, right? Because the market was moving lower. So this is our lower high that the market created before creating our lower low, right? That means if this is our lower low, right here, we have a break of structure, right? The market moved higher than this lower low or lower high, sorry. So what would this be then, right? If this is our lower high, this is our lower low, and we just made a new high, this would be our higher high, right? And then because this low is higher than this low, this would also be our higher low, right? Because this low is higher than this previous low that we had. So now, since we have 3 to 4 highs and lows marked up, we now understand that we are in which trend? Drop in the chat. Which trend you guys think we're in? An uptrend, exactly. Right, so we are now in an uptrend. Right, we are now only looking for buys. Right, we don't want to look for sells in an uptrend because we're going against the trend, right? You want to trade with the trend. The trend is your friend, right? We now have our daily range, right? We know where our daily highs and lows are. This is our daily low. This is our daily high. We now understand that we're in an uptrend because we found our lower high, our lower low. We made a higher high and now a higher low, right? If this right here, this move would have broke below and created a new lower low than this low, we would be in a downtrend. But because it's higher than this low, we are in an uptrend. Right? We're looking for buys. Now that's step one, right? We figured out the daily range and our trend. Now we drop down to the 1 hour time frame, right? And look for potential zones that the market can react off of, right? Our zones are not just any zones that we want to mark up, right? Or just random areas that we think the market can react off of, right? If you don't understand where to look, right, you want to look for areas where the market has either peaked, right, has made a peak or a valley, right? This is what we call resistance and support. If we're in a buy market, in a bullish market like this, right, we're making highs and lows consistently higher, we look for the market to react off of the peaks, right? Because this peak was once resistance, right? The market either resisted off of here, right? Resisted until it broke through. And now we're looking for this peak, this resistance to now become support and for us to continue higher like this, right? If we're in a sell market, right? If the market is trending lower, we are looking for the market to react off of the valleys, right? Which used to be support, but now because we broke through, it becomes resistance, and that's where we want to find our entries to continue lower, right? Hopefully that makes sense. But we're going to show you guys on the chart now with Bitcoin, right? Where are those zones that we want to find, right? If you don't know where those peaks and valleys are, right? In this case, we're looking for buys. They have to be under the price, right? Below where current price is. We can go from a candlestick chart to a line chart, right? And this line chart, it takes out all of the wicks, all of the candle bodies, and it just shows you the peaks and valleys that have been created, right? In this case, we're going to look for multiple touches in a zone, right? We're going to go like this, take a horizontal ray, right? Closest to price, we can see that right here, the market came down, used this area as support, right? We see we have a peak right here, but the market used this area in the past as support, right? And then once it broke below that zone, right, we came back up and used it as resistance, right? We resisted and continued lower. Now we broke above, and we're going to expect to use this again as support as we did here, right? We have 1, 2, 3 touches in the zone, right? And then the second one that I'm going to look for is right here, is this peak, right? Because we have it broke below, it resisted off of this zone, it broke above, and now we want to see this to be our support again, right? So instead of drawing lines like I just did, just to show you guys, we want to draw a rectangle, right? So we have from this first zone right here, right? And the second zone is right here. So from these two peaks that we have, right, what we want to identify now that we understand where we have our zones, we want to find a candle to represent our zone, right? If you can't see candle right away, right, at the top of the zone, here, for example, we can see that we have a big candle right here. You don't want the candle to be too big. You don't want it to be too small, right? This one right here in the second zone would actually be a perfect candle. We're going to mark this out using an arrow, which is this candle that we used, right, to mark our zone. But the second one, we can see that we don't really have a candle to use in that area, right? So what you can do is go back to where price was previously at, right? And see where did the market react in this area. I'm just gonna might have to go back a little bit on Bitcoin. We go to the 4-hour chart, makes it a little bit easier. Right, we want to see where is there. I guess this is, if we look at this like this, now on the 4-hour, we can see that here the market actually used this zone previously when we first hit 113,000, right? When we broke above this area, we broke above, used this as support, and then came down. So what we can actually do, right, is use, if we just mark a new zone here, we can actually use this candle over here, right? Because it's still in our zone. We still had multiple touches from that area, right? It's just a little bit further back that we found this zone, right? It's not directly where we are looking right now, but sometimes you have to go back, right? That's my bad. Move it there a little bit. Sometimes you have to go back in time to see where the market reacted, right? And find a zone that better fits what you're looking for, right? So right there is our zone that we're going to be looking for, right? Our two zones that we're going to be looking for. Because if the first zone, right, this first area that we have, if it gets broken through, we're going to look for the market to react off of the second zone, right? We have a backup zone because the market doesn't always have to react off of every single zone that we mark up, right? Sometimes the market will go through, it will play below, and then it will react off of the second zone, right? This is why we have two zones, because if that happens, right, we're not wondering, oh, why did the market, not react in my zone? Now you have two zones where the market can potentially react off of, right? So in this case, what we want to do with the zone as well, we want to put a price label so we know where we're actually executing this trade. And so in this case, we want to use quarter level theory, right? So round it up to the nearest quarter level. And this is 113,499. So I would just round this up to 113,500, right? And this one right here is 112,875.17. I would just round this up to, sure why it's not letting me type here, to 112,875. Right now we have our two zones that we are going to look for the market to react off of. Right? Does that make sense? Do I still have everybody? You guys understanding this? Drop a 1 in the chat if this is making sense. Awesome. So now once we have our zones established, right, we understand where we're looking for the market to react off of, what do we do, right? If we go back, I guess I deleted that, but step number 3, right? Now that we have the second step done, we have found the zone. Step number 3 is waiting for the breakout, right? Waiting for the reaction in our zone. So if we take a look up here, what we're going to do is draw this out for everybody. All right, so let's say we have our zone that looks like this. All right, not too big, not too small. We have the perfect zone that we found at the closest support or resistance. And now what we do, right, is the market is eventually going to either have to come lower and play into our zone and then react, or go lower and play into our second zone. All right, let's just mark up a second zone here. Or right? This is an ideal scenario is when the market reacts, or it's just going to continue higher right from here and then give us a different area to look at, right? But what we want to do is once we have our two zones, right, we want to look for the market to react out of the zone, right? If we're looking for sells, we're looking for the market to react in an M formation to give us two touches in our zone, right? We can see we have two highs or two touches in our zone, right? If we're looking for buys, we want the opposite. We want two touches and a W in our zone, right? It's not always going to be, right, the perfect W where it looks exactly like this, right? This is one W that could happen. A second one that could happen is we have our first leg is higher than our second leg, right? Something like that. Our second leg is actually lower, but you can still see the W, right? Or we have one like this, right? Where the first leg is now lower than the second leg. Does that make sense? And then the same thing for the M, right? It doesn't always have to be a perfect M like this. It could be an M like that, where this high is, higher than this one, or the second touch, and then we could have one that's like that, right? We want to make sure that the M and the W are in our zone, right? We're reacting off of the areas that we have marked out. So now, if we take a look at Bitcoin, right, this is actually two areas that I had marked up previously. There's actually a trade that I was in this morning, and I'll explain to you guys why, right? Right at the moment, you can see that we are above the zone, right? We already kind of played above. We're waiting for a reaction. But this morning, we had the exact same zones, right? But minus all of this data that we printed, these candles that we printed over here, right? And what ended up happening was we ended up playing through our first zone, right? And this is why it's important to wait for the M or the W, is because this candle right here, let me just circle it, right? This big candle right here, did it stop in our zone at all? Right? Did it give us a reaction? Did it give us an M or a W? Right? We're actually going to break this down to the 15-minute time frame as well for the M and the W, right? But right here, that 1 hour candle, did it give a reaction in our zone? In the first zone that we have. Let me check the chat. So sometimes what will happen, just to answer your question, if the M or W that doesn't touch the zone, right? Sometimes what will happen is the M or the W will get created outside of your zone, right? So let's say if we go back up here for this example, right? Sometimes it will go like this and then just miss your zone and react higher and then continue in the direction that you wanted to. I am not taking this trade, right? Even though we saw the reaction, right, that we want, we didn't see the reaction in our zone, right? We want to wait for the market to react off of our zone, right? If the market does something like this, right, this is not us sticking to our trading plan, but if the market breaks below and does something like this, I would consider this still an active trade, right? The market reacted out of our zone, right? We didn't break lower and go into this zone, right? We reacted off of our first zone. Yes, we broke below it a little bit, but we still respected this area, right? If the market reacted above and gave us a W and went up, I would not enter that trade because using the trend trap strategy, you want to wait for the market to react in our zones that we have marked out. Right? That's called sticking to our trading plan. Hopefully that makes sense. But in this case, right, I was looking for the market to react off of this first zone, but what I ended up noticing was we just broke straight through the zone and we never got a reaction higher, right? If we use the brush here, we went lower and then continued lower, right? We didn't stop and give us a reaction for a buy. But the reason why we have two zones is you can very clearly see on this 15-minute time frame is that in the second zone, the market gave us a reaction, right? It gave us a breakout and a reaction from our zone, right? So the breakout with this strategy within our zone, once we have the reaction, is something that we call the counter trend line breakout, right? So if you can't draw a proper counter trend line, right, you can also go down to the 5-minute time frame to see your M's and W's and draw out the counter trend line, right? So in this case, what I ended up doing was I saw that we had our W, and you'd want to draw a trend line, right, from a red wick to the top of this W, right? We can see here that's the first leg. We topped out here, created the second leg. This is the top of our W. From this wick to this wick, that's our counter trend line. And we want to wait for the market to open and close with one candle above it. Right? So we opened and closed right here with this candle. Right? You can see that the candle opened and closed above this counter trend line. And that would have been our entry zone. Right? Now, what we could have done, which I actually ended up doing, is getting in this trade, is placing our stop loss beneath this low, right, that created the breakout. So the second leg of the W or the second leg of the M is our stop loss. With now the closest highs to price being our take profit zone, right? We want a minimum of a 3-to-1 risk to reward, right? Which, as you can see, this is a 4.37. We're targeting the highs, but if you take this down to a 3-to-1 risk to reward ratio trade, we can see it was actually a lot lower. Does that make sense? We drew out a 3-to-1 from exactly where our entry was. We have our stop loss. We drag this tool up, a 3-to-1 risk to reward trade, and this went for about 1,000 pips, right? And you could still, this is still an active trade that we can look to take, right, if it reacts in our zone again. Or we look for these highs if you're still in this trade, right? If you took this trade. And then we look to attack, right, the next highs. We go to the 15-minute time frame. We can see that this is our high. Then we can attack this highs right here at 115,000, right, which is also where our daily level is. And then look to play above our daily zone and continue into the uptrend, right? Create a new higher high and then wait for more reactions and new zones to be created. Does that make sense? We look for the counter trend line, the M or the W, on the 15-minute or the 5-minute time frame. Right? This is called the reaction. We're waiting for the breakout, and then we're exiting our trades at the nearest highs, right, if there are at least a 1-to-3 risk to reward ratio. Right? That means right now, if we took this trade, right, to where it went, we would be sitting in profit 1.343 risk to reward, right? So even more than a 3-to-1 risk to reward. But if you just chose to do 3-to-1, right, which is what we always want to aim for, we don't want to do less than that. You would have already been taken out of profit in this trade, and now waiting for the market to either react off of the zone again, or just continue higher and then create new zones. Right. This is why 2 zones is always important, because like I said, the first one does not always get the reaction right away. Right. But now, if we're waiting for this market to continue to print out, we might get a reaction off of this first zone that we have here. Right. We can use this zone again to take the same trade from these areas, right? Because we're still in an uptrend, right? Just because we took this trade one time from this area doesn't mean we can't use it again. We can use it over and over again until the market shows us that there's different zones that need to be, reacted off of, or better zones that are closer to price, right? Or if we make a new high, we're going to be looking for different trades, right? But until we're out of this area and we don't have a better zone to look for the trades, we can reuse these zones as many times as we see fit, right? Until the market tells us that it wants to do otherwise, right? And then the shield, right? Step number 4 is to protect your capital. Always use the second leg of the M or the W, right? In this case, we see here, we had the W being created, right? Let's draw this out. First leg, middle of the W, second leg, we had our breakout right here. This is our stop loss beneath this low, and then we're targeting a 3-to-1 risk to reward, right? Very simple, very straightforward. You're waiting for the market to react in your zone, because if it doesn't, right, then it's not a valid trade. You're sticking to your trading plan. You're using proper risk management, right? You're understanding how the trend trap strategy works, and you put it all together, and this is exactly what it should look like, right? But I hope you guys all got some value from tonight's call. If you have any questions, I'm going to look through the chat box right now as well. What time frame should we be looking for the M or W on? So we want to always look for the 15-minute or the 5-minute time frame for the M or W, right? The 4-hour time frame is only for looking for the trend, right? Where is the market headed to? This is what we did right here, right? Doing our top-down analysis, the daily time frame, right, is where we start. We look for our daily range. What's the range where we're going to be trading in? Right, we figured out that this is our daily low and this is our daily high. Then we go to the 4-hour, right? We do top-down analysis, start on the bigger time frame and work our way down. Now we're on the 4-hour. We identified our highs and our lows, right? We have our lower low right here. We identified that this was a lower high that was created, which was followed by a higher high and then a higher low. So we are in an uptrend. The 1-hour, we looked for our zones at peaks and valleys, depending on if we're in an uptrend or a downtrend. For downtrend, we look for the valleys to take our zones, and in an uptrend, we look for the peaks. We found our 2 zones, and then we go down to the 15-minute time frame or the 5-minute time frame if it's easier to see or easier to draw your counter trend line like it was right here, to get your counter trend line break, the open and close of a candle above the counter trend line, and then that's our entry zone right there. Hopefully that all makes sense for you guys. Hopefully you guys got some value, right? Go back into your chat and drop your biggest takeaway in the family chat as well, right? I'm going to be doing some more starting next week. We're going to do looking at multiple different pairs, going through and just marking it up, with you guys, and you're going to see what we can find together in these markets for different trades using the trend trap strategy. But drop your biggest takeaways in the family chat, and I will see you guys all next week on Tuesday. Peace.